Good morning, everybody. Just as everyone is joining, I'll just run through a little bit of housekeeping. Everybody's cameras are off, and at the moment, I think everybody's on mute. If you've got any questions, on the top of the toolbar in the square speech bubble with a question mark in it, you can put any questions and I'll try and pick them up as we go. I know some people that have registered have already sent in questions, which I'll try and put in as we go along, or there will be time for Q&A. So we've got 45 minutes. This isn't a presentation. This is going to be a discussion. And it's the third in our series of building financial resilience. And what we're doing is we're taking a business through its business life cycle. So we started with when you start up a business, and ironically, we started with exit strategy. So know where you want to go. We then looked at undiluted funding. So maybe how you would start that beginning bit of innovation. So how you may use grants or other types of undiluted funding. And we're now looking at what we need to do if we're going into equity funding and what that can look like and how you can plan for it. We know, though, that as in a business journey, your needs for funding at various stages will change, and you may find that at a later stage in your business that you'll need a different type of funding or more investment. The experts that I have today, we're trying to concentrate on the early stage at that beginning and planning, but either of them can also help you and support with what you might need later on. And if any of you have got any specific questions or you want to have some one-to-one time with either of the experts, and if you come back to me, I can arrange that for you. So let's start with introductions. I'm Samantha Wildman. I'm Group Client Director here at the MPA Group, and my role is really about dealing with the clients, and it's about understanding their needs, the pains that they've got, and helping them find a solution. And a lot of the time, I can't do that without having my experts around me, and I'd like to introduce two of those today. Malcolm from EFM and Robin from Rafina Capital. And they're going to be taking on two different roles. Malcolm is going to sort of try and help look at it from a client's perspective, and Robin from an investor's perspective. Malcolm, would you like to introduce yourself first?
Thanks, Samantha. Yes, good morning, everyone. I'm Malcolm Holloway. I help run the Portfolio Finance Director Network here at MPA. So I am a Portfolio Finance Director. I've been doing that for about 20 years now. My speciality is helping particularly small and early ambitious SMEs raise funds. So I've probably helped over the last 20 years about 100 raise all sorts of funds from seed to early stage growth capital, dilutive, undilutive, and just really help take people through that journey. I've also had a spell running a small loan fund. Part of my role remit here up in the northern part of the country was to run one of the regional funds that we do. So I've also seen it not only from the client perspective and helping clients through the maze of raising their first dilutive capital, but I've also had a bit of experience of running a small loan fund. So we had a small fund of about 10 million, did about 70 investments. I've also had a bit of experience on exit and mergers and acquisitions. So very much a general practitioner, but very focused on the early stage business life cycle.
Excellent. And Robin?
So, good morning, Sam. Good morning, Malcolm, and good morning, everybody else. So I'm Robin Rowland Hill. I'm the founder of Rafina Capital. I founded the business about 10 years ago with a handful of others. Background has been in design and technology, actually. Built my first proper business, I would say, around the millennium, and have invested in other people's businesses as well as founded 2 or 3 others myself. One of which took to partial exit. And these days we advise what we call growth stage businesses. So that's labeled these days as Series A and beyond. So we have a pan-European network of some many thousands of private investors, less so, but family offices, VC funds, corporate venture partners, private and institutional lenders, and secondary buyers. And so they're looking, and we're looking for really interesting well-managed growing businesses, looking typically for a check of a few million up to about 25 million in either equity, debt, or secondaries, or they're doing an M&A transaction. And we're based in London. We have a satellite office in Amsterdam, and we're opening one in Cayman, where one of our team is now based.
Excellent. So I have some questions that we commonly get asked around investment. And I think my challenge today is going to be able to make sure we can keep that within the time slot we've got, because I know you two both have an absolute wealth of experience. And then I'll try and put in some of the questions that we've been asked as well. I think my first question is going to be, and I'm going to sort of ask you both individually the questions, but Malcolm, I'm going to start with you. If I was a business, ideally, at what stage should I start planning and thinking about going out for investment?
The answer is as early as possible. In taking investment is not like just applying for a loan online with the bank that can done these days in 48 hours. Taking investment on board can take up to 6 months, typical deal transaction 3 to 4 months. So there's a lot of planning. And in order to get there, you need to be ready for that process. So I would say as early as possible, possibly even a year and a half in advance of when you actually are likely to need the funding, because it takes the pressure off when the funding can arrive, because these things do take time. And a lot of businesses are not ready for investment.
Excellent. And Robin?
I was just going to jump in there, actually. I would completely agree. I mean, we see businesses that are, they need the capital within the next, 3 or 4 months, and that's frankly a bit tight. Ideally, you want to plan these things, 6+ months ahead, because it's not just actually starting the process of talking to investors. You've got to prepare all the materials, data room to document your business and what you plan to do and so on. And the period before that is thinking about what you want to do. Do you need to raise X or 2X? And is it debt? Is it equity? When would you ideally do it? You want to probably fit it around your growth plans or restructuring the business and so on. So as Malcolm's headlined, it takes time to do it. And it also, I suppose, implies that management is not managing as well as it could be if you're trying to do it in a hurry.
I think the point Robin makes about being prepared, I think there is a lot of thinking that a business needs to do before it starts to reach out to potential investors, making sure the management team are aligned, as Robin says, making sure you know how much you need, you've got enough contingency, and just to show that you've actually thought about the process. Because investors like to see businesses that are well prepared. And it's not just because it makes it easier for them to look at the numbers, but it shows it's a properly run business with a structure and a plan. And that, in terms of building investor confidence, can be really important.
Excellent. So if somebody was then going out and looking for investment, this is all about equity. How much equity should a business be looking to give away, or how much equity would an investor want? And again, I'm going to start with Malcolm, and then Robin, you can do it from the investor's point of view.
I think you got the point right about giving away. It's not about giving away equity. It's about building on the future. But typically in early stage, so my experience is probably fundraisers of anywhere from 150 to 500,000. So really early seed type raises. Typically an early stage investor is going to want 20 or 30% of the business for that sort of money. Now they might want less if you are well structured, you've got a good business plan, you've got a demonstrable product. But you're not going to get away with only giving away 5 or 10% of the business, or unlikely to at that sort of level. But it's not about giving away, it's about what you can do with the money, which is why the planning is really important. It's about sort of focusing, and I know a lot of early stage investors, businesses I talk to, get very sort of hung up on this view about I'm giving away equity. What you're doing is bringing on a partner who's got something that can help you accelerate the business.
Yeah, I would completely agree, Malcolm. And I suppose it is a trade, of course, the equity that is being bought by the incoming investor. I have to say we don't see different numbers really at the higher levels. That most funds and investors, when you're asking them for a larger sum of money, a few £1 million, they also want 20 or 30%. Unless you can justify a very firm valuation, that's usually driven, by strong numbers. So if you're a tech business, you've got 10 million turnover, you're growing, you're doubling size every year, you can defend a good, strong valuation. And then you can negotiate a smaller percentage because multiples apply even in these depressed markets. They're getting better, I have to say. But if you're still more promise than traction and fact, then it becomes a negotiation because the valuation is frankly subjective. I know we're probably going to come on to valuation, but then an investor, if they're putting in a few £1 million, will want a decent piece of the pie, and that's how they will look at it.
Thank you, Robin. You've teed it up really nicely. There must be issues around how businesses are valued from a startup's point of view and from an investor's point of view. So, how do you value a business? Robin, you can start with that one.
Okay, thank you. Well, it depends is the simple answer. Um, Clearly, the way businesses are normally valued when they're established trading and got a certain amount of commercial traction contracts, they're growing, then multiples are usually used. So multiples of turnover for tech businesses in particular, or multiples of EBITDA. But in the earlier stages, that doesn't really work. So you need to look at other transactions, comparables, as we would call them in the market. I think you've got to look at the strength of the management team, the nature of the early sales they've got. Are they contracted? Are they subscription based? Are they repeatable? Is it project-based work? That can be good and less good depending on what you're doing. So there's lots of different ways of looking at it. But ultimately, an investor is going to give you equity capital to grow the business. They will want to balance that risk and reward. So they want to share in the upside you're promising them. But you're also effectively going to be married for the next few years in the same business. So I would argue on valuation that use an advisor or have somebody look at the valuation and give you an honest assessment. In essence, the entrepreneur understandably will have a much higher expectation of value and the investor a lower one, and there's always a gap. And as an advisory firm, we work for the entrepreneur, not the investor, but we'll seek to bridge that gap with reasonable arguments and compromise and structures and so on. There's various ways of doing that. But ultimately, you do not want a winner, really. So you don't want the company to, frankly, raise money at too high a price because it creates problems down the line. The investor will start to resent it. The next round will also then typically have to be priced too high, and the next lot of investors won't pay it. So overdoing valuation is a problem. And underdoing it, the investor buying too much of the business and crushing earlier investors in terms of price is also a very bad recipe. So you've got to end up with a fair compromise. A little give and take on both sides is ideal.
Excellent. Malcolm, anything to add to that?
Yeah, I think it's one of the big challenges. I get involved with a lot of early stage businesses where there aren't any metrics, as Robin said. So we don't, could be it's pre-revenue, could be it's still loss making. In fact, most instances in the early stage seed function, it is loss making. So there's no real metrics that you can judge a valuation around. If you can find a comparable transaction, i.e. a business similar to what you are trying to establish and what it's sold at, then that can give you a marker. But they tend to be businesses that, again, have got traction and size and scale, and therefore it's very hard. And certainly when I ran the small sort of equity fund, we were doing sort of the smaller end deals, we looked very much at the potential. And I think there's as much of a question of what you're going to give away. It's about what you can return. to the investor. And typically as an early stage investor, we look to try and get a 10 times return. So that's why as Robin said, the numbers become very important and believable numbers. We wouldn't just take, with my investor hat on now, but also it helps when I'm talking to entrepreneurs. Most investors will sensitize forecasts. They won't necessarily, not that they don't believe what management's saying is going to happen, but they know that with experience that things go wrong. And therefore there needs to be enough growth potential in the business to be able to get a reasonable return and a reasonable time to pay back. And the second point, certainly at early stage, most entrepreneurs that I act for aren't often lucky enough to have more than one investor. If they can find the first investor, they're lucky. Obviously, bringing in, if you can get more than one investor, you can get a bit of competitive tension into any negotiation. But in reality, at early stage, the investor normally drives the valuation. So my advice normally to people is not to get too hung up on valuation, but to just try and do the best they can to get an offer out of a decent VC or institution, because they will set the price. It's a bit like if you're trying to sell your house, you may have a view on what your house is worth, but if no one will pay the price, then that's a bit of an arbitrary number. So so I spend a lot of time talking to entrepreneurs saying, look, let's not get too hung up on valuation at this stage. Let's just see if we can get an offer or two. Because once the money people have put their stake on the table, you've got something to negotiate around, and it's easy to put off. So if you go into a negotiation saying that we only want to give away 2 or 3% of the business, then the investor's just going to move on to the next deal, which is possibly easier for them to do. So valuation is something that is more of an art at early stage than a science, but it's about being ready and understanding your numbers. And I think the final point I'll say on that is, it goes back to this giving away. If you don't give away 20% of your business, you still retain 80%. And if the investor's money can help you make that 80% a lot more than the 100% that you had before, then it's not really giving away, it's actually growing the capital value of your business. And if you can't make that leap with an investor's money, you shouldn't be raising investment anyway.
I think I'd add a couple of points there, Sam, if I may. I think the first one is about the nature of rounds at the earlier stage. So I worked at a large, very well-established investment firm before Rafina, and I became what they call the rainmaker, because I was doing a lot of businesses, working with a lot of businesses, raising a lot of capital there. And generally the audience were business angels. So you're raising more modest amounts of money, $250,000 to $500,000, that sort of area is pretty typical. And so the round would be made up of a number of investors. Rarely was it one check. It was half a dozen to a dozen checks. So I found the secret was to always find who the lead investor was. And it was typically a he or she who knew something about the sector, was very excited by the team and the opportunity, liked the people, and also could write a decent sized check, probably a third or half of the ask, the round that you're seeking. And they're in the sort of pole position to shape the deal. Once everybody else just follows. They either won't do the homework or they're not writing a big enough check to call the shots, frankly. So I was always looking for that lead investor, whoever got it, whatever the company was doing. And then you work with them and the client to come to a sensible arrangement, and the others will follow. In the later stages, you're talking about institutional capital more often. And frankly, they've got pretty pointy elbows and they do not play nicely together. Some do, but most don't. So you're looking for one check. So the game there is slightly different, and you need to really court several different investors. And that all comes down to preparation and proper structure and a deal and going to the right people so that you have some rival offers. Puts you in a better position as the entrepreneur. Not easy to do. Not easy to do. But the last point Malcolm makes in terms of not getting hung up on valuation, I think is key. Because frankly, at an early stage, nobody's going to buy your business. So you might own a certain, a controlling interest in it, but if you can't sell it, it's worthless. It's only worth something in a few years' time after couple more rounds of investment. So what's important is how much you end up with at the end of the process. But what the deal you do today, you can recoup some of that equity by agreeing structures around options for management delivering the numbers, because the investor will feel more comfortable having more of the equity and holding management's feet to the fire. And if management delivers the numbers in the business plan and the forecast, it's only right they should get some of the equity back. And that's very common. And so getting hung up on how much you've given away, as Malcolm was calling it now, is it is important, but it's not as important as actually getting the investment in the first place.
Excellent.
And I think sometimes that's where taking good advice helps, because a good advisor will take you through that process. So the typical, and only anecdotally, I've done 3 or 4 exits of tech creative businesses, and the ownership is normally down to about 15 or 20% at that stage. But because the exits are reasonably sized, that still gives a pretty good return for the owner. So it's about looking at what you've got left at the end of the day compared to potential exit value, rather than be too greedy at the beginning.
Yeah, so we've got a client at the moment who just working with at the moment. We've just put some more equity in, and we've got some other people at the table. There's a transaction probably going to go on later this year, which values the business, well, 400 or 500 million probably. The founder has been through 16 rounds of investment, and so they probably have high teens in terms of share ownership. But depending on the deal that's done, if I doubt there'll be an exit this year, but if it's in a year or two's time, that's still 100 million plus. But they wouldn't have got there if it wasn't for the 16 rounds of investment.
I think that's a really good point, Robin, because most businesses need more money than they think they do. And some of that's down to poor planning, some of that's down to market conditions, tech problems. But, the typical rule of thumb that we applied was, most businesses need 4 times as much as they think they do, and therefore will have a minimum of 4 rounds. And certainly the exits that I've been involved with, there's been 5 or 6 rounds of funding before we've got to exit.
Yeah, and also, frankly, their case is a particular one, but we've seen it in many other clients. What they're doing now to create that strong growth and market traction and so on is not what they were doing 7 years ago when we first worked with them. So the business has tacked left, tacked right to find the precise version of their business model that really, really works. And the market's changed, of course, and we've had a pandemic in the middle and all the rest of it. So businesses have to evolve. And the thing that really works from a scaling point of view, they don't necessarily have on day one. You only find out once you get into the battle.
Brilliant. So you've answered loads of my questions I've got later on down in my list, but I might recap on some of them. But my next question, I'm going to do in 2 phases. I'm going to ask Malcolm the first part, and then the second part is coming from a client a little bit more specific, which I'm then going to direct at Robin. So the first part to Malcolm is, when a business is out there looking for investors, what criteria should they be using to evaluate what is or who could be the best potential investor for them?
And I think the answer is that it's about regarding it a bit like, in a way, a job interview. You need to do your homework on the funds. And the way you can do your homework on the funds is to make sure that they have a natural fit with what you do. So, for example, the fund that I ran was based for companies in the northeast of England. If you weren't in the northeast of England, then it wasn't worth applying, because you wouldn't get an equity investment from them. So doing a bit of homework about the type and nature of the fund, but questions like, have they got experience in the sector? What can they bring? Can they follow on? We've talked about needing multiple rounds of money. Are the investors able to follow on? Because if you're going to need more money, you don't want to be going out to a new investor every round. And I think the most important thing for me, and the thing that I'm amazed that most entrepreneurs don't do, is talk to some of the people the fund's invested in before. There's normally on most fund managers' websites a list of client investees who they've invested money. Pick up the phone to them. Most people are more than happy to give you a reference about who. So it's about doing your homework for me.
Excellent. And then Robin, I'm going to sort of spin that over, but a client's asked, what is an investor looking for from both founder qualities and a target business perspective?
Right, there's probably a bunch of answers there, but I would say, firstly, from the founder or founding team, it depends at the stage you're talking about. Obviously, it's very early stage. You're backing the founder, but depends how the business has grown. But as it grows, you'll end up with a management team, and it also depends on what the business does as to how critical that team is. So I can recall one particular investment that was founder-led. It was quite early stage, but the investors collectively would not put the money in until the marketing director was found, because it was a tech platform essentially operating B2C. So you needed to get the marketing right in order to scale. And they had somebody in the wings who was going to join the company. They'd headhunted, but ultimately investors would not put the money in until he was appointed. So to answer the question, it slightly depends on the stage. The later the stage of the business is going to be bigger, complex, it'll have more people in it, and the investor or investors plural or the fund or whoever it is will want to meet that management team and be comfortable that they work well together, they all see the same vision, they're competent, excited, and so on. That's critical. They always say only invest in three things: management, management, and management. So it's quite important, because you can have a great product and hopeless management, and you can guess where that's going to end up. But the other way around, the good management team will fix the hopeless product and it will become a good business.
Yeah, I
And the
think the
second
point
part,
is that an investor would rather invest in a good management team than necessarily a good product. Ideally, they want both, but it's the management team that's going to deliver, particularly at early stage. And they also want to see what we would call sort of skin in the game, which is actually having an involvement on the business. So one of the areas I see often challenging is management, because they want to commit full time. For an early stage business, that's often a no-no. So ideally, an investor wants to see that you've got a commitment into that business that is full time, not sort of hedging your bets and trying to sort of run a job on the side. So that commitment is really important, and that can be really difficult for an early stage business if they've not got much money. And therefore, one of the big challenges we often get is salary expectations from early stage founders, because the investor is not going to want to pay a full range salary for an early stage business, because otherwise it's a bit like a job. And therefore, the early stage founder is going to have to give away some of their income entitlement just to sort of match the money the investor's putting in. And that's often quite a difficult journey to navigate between investor and entrepreneur.
I think we see that in later stage as well, that the management team should be properly paid, but not necessarily the high rates you see in some industries, because until you're generating profits, you're living on shareholder funds, really. So recognize everybody's got to live and so on. Everybody should have ideally a stake in the business, but they're there for the significant upside that their share allocation will give them. Early stage, you should be living on live and air. That's about it, I guess. So.
That's what the investors want, but persuading them that you do need something to pay your rent is quite difficult.
Yeah.
But it's one of the more contentious points in early stage investing. What does a founder what kind of salary entitlement should a founder have? And that's where you really need to take proper advice.
Just to pick up on the second part of the question, which was about the business objectives, I suppose. I mean, ultimately, most investors, regardless of stage, they're investing for a period, and they want to be comfortable that there's a way to exit the business, because it's not like buying some stocks and shares on the stock market, where you can just decide to sell this weekend because you'd like to go on holiday or something and sell some shares. It's difficult to sell shares in private companies. You've got to find a buyer who likes a secondary buyer, or sell the entire business, probably. And so as an investor, a shareholder, you have no control over that. That's down to the management team and their strategy and their plan and opportunities in the market. So once you're investing, you're going to be in there probably for a few years. And it's classically talked about 3 to 5 years, but really that means about 4 to 10 in the real world. So the DTI, they're not called that anymore. Pre-pandemic, the average time frame for a business in the UK to start trading and exit, assuming it survived, of course, was about 7 or 8 years. Well, these days it's a lot longer. It's a decade or more. Now, we've had a pandemic in between and a few other inconveniences, and perhaps it'll come back to that 7 or 8 years. But if you're investing very early stage, you might be in for quite a long time. If you're investing a little later, then it's probably nearer the 5. But in both cases, you want to know that management has a clear idea about how they're going to exit. And just saying, oh, we're going to sell the business or do an IPO doesn't wash. Why would you IPO? What other businesses have IPO'd? IPOs are expensive, risky, and nobody's doing it at the moment, or very few, except huge businesses. So that means some sort of trade sale probably, or it could be a private equity buy-in because the business has got to a certain stage. We've had that with a few of our clients, where they buy the business from the previous VC funder. But if that's the way you exit a business, then you need to look at other businesses in your space. How have they done it? What sort of price was paid? What sort of scale were they at? And how are you going to get from where you are now to that scale to achieve that sort of exit? Even if your path ends up being different, at least you've done the homework in terms of how you're going to do that.
I think that goes a bit to doing homework on your investor too. I have seen certain funds, particularly up here in the northern part of the country, where the investor does actually have the right to force a sale because they have what is a closed fund. And therefore, they need to pay their money back to their investors within a certain time scale. And understanding that, and therefore, though it may not be management's wishes to sell, the investors sometimes have rights to force that sale. Now, that's quite a contentious issue, but that goes to the heart about understanding your investor and what their timescales are like and what options they've got.
Yes, I worked with an investor who's kind of retired from investing now for many years, and his preferred approach was using a CLN, convertible loan note. So he would lend a business $250,000 to $500,000 with a coupon, modest coupon, and then there were conversion rights in 2 or 3 years. And if the business was off plan or couldn't repay the loan, then it was quite onerous in terms of the equity that he then commanded, which meant he could lead to forcing a sale or some other kind of transaction if wanted. So in those sort of situations, it can be very good for management if you deliver the promise, because it's a loan, not equity, which means it's much better for you. But if you miss your numbers, it's much less good.
Yeah, I've had one of those recently where we had some convertible loans involved from the Future Fund, which was a British business banking incentive during COVID, and trying to unwind convertible loans when things aren't going well. The investor or the loan note holder has all the power, regardless of their shareholding, if they have one. So you need to be really careful, because convertible loan notes seem very attractive because if you can repay them, you don't have to give away any dilutive equity. But that's only if things go well. And we all know that in particularly early stage business, the chances of things going well are small to zero.
Yeah, well, it's a bit harsh, but zero.
Well, yeah, probably. That's probably my experience of my fund. So just for some numbers, guys, on the fund that I was involved with, we did 79 investments. We only made a return out of 4 of them.
Ouch.
Although one of them got us 17 times our money. So we actually made money as a fund because we did pick a really good winner. But that's one of the reasons that early stage investors want such a large return, because they know that typically, there's no actual hard and fast data, but typically it's sort of 2 to 4 out of 10 will return something to the fund. And was that your experience, Robin?
Very typical, yes. I mean, I'm thinking of a family office that we've worked with routinely over the years, and they've got 50 odd investments. One of the 3 good ones is a client of ours, And they've got two others that are huge now, hundreds of millions of turnover and very profitable. But the rest are going nowhere. And so they'll make, if they exit all three businesses in the coming years, they'll make very good returns. But it means, 40 odd out of 50, not so good. But they were investing early stage tech, like a lot of VC firms do. And it's risky. It's risky.
Right, so you covered an awful lot there. So I did have a question from one of the people that registered, which you've answered, Robin, which was, how long should you plan for an investor to be working within your business? And you've said anything between 3 and 10 years, depending on how they're going to exit. The next part of the question was, or somebody else had added on, was how much involvement would you expect that investor to have during that timescale that they're involved?
If I jump in there, well, the short answer is if it's an earlier stage and you've got a number of essentially business angels or private individuals, then the lead investor I referred to earlier probably will stay involved, might become a board member and represent other investors, will have usually has some experience and excitement around the sector or the business, and therefore is useful. So in answer to an earlier question, what's the kind of capital you'd search for? And it would be that's what we look for as a company, the best kind of investment capital. So it's not just the money, it's all the smarts and the experience and the help with exits that they've got experience of. So it's likely that lead investor would be the man or woman who would be useful to the business and be involved. The others less so. And my piece of advice I would give is always produce a quarterly update to all shareholders on the first day of the quarter. And ideally, you just do it on a calendar year basis, 1st of April, 1st of July, and so on. Can be half a page. Does not need to be complicated. But when things go wrong, which in 3 to 10 years they definitely will, probably twice, you will need them to put more money in. And if you haven't communicated with them, how keen do you think they will be to put more money in? Yeah, the answer is no, they won't be. So that's just as an aside. But I think the other point is that if you're looking at more institutional money, it's bigger check, and it's probably one check. They will want at least one board seat, and they will want regular board meetings, anything from quarterly to monthly, and they can be very helpful. But they'll work very closely with you, some funds, and it depends what you want, what your sector is it you're working in. But if you're talking about institutional capital, then they're going to sit around the table with you every month. So choose wisely.
It does depend on the stage of the business, because certainly in the fund that we run, we were a fairly small team of 5 or 6 people with 70, 80 investments. So you haven't got time to spend a lot of time, although at least one regular monthly conversation with the client would be acceptable. But it's when things go wrong that you start to get a bit more involved, or if you get near an exit or an event of some type. But I think Robin's point I would reiterate, one of the things I spend a lot of time working with my entrepreneurs with is building those relationships with their investors, because you never know when you're going to need them. And therefore, making sure that they are aware of where you are, what you're doing, you've communicated properly. Because when you go to them for extra money, if they can look back and see that you've regularly given them information, you've kept them up to date, that's a big tick in the box from someone who's been a stranger to them.
Yeah, it's very true, because it is about that relationship. And if you've got regular communication, just like having a network of friends, if you don't talk to your friends for years on end, they're not going to invite you around for dinner, are they? So
you probably wouldn't invite me around for dinner anyway, but
get new friends.
And you've touched on this a little bit, but I think it's really good to just go over it again. You've mentioned a few times that especially in these early stages, how many businesses fall into issues. They're not maybe meeting their projections on cash flow or sales or product development. What are the pitfalls that can happen when things don't go to plan, and what are the risks for the business when that happens?
Well,
It's a big question.
big question. Well, fundamentally, if things go horribly wrong, the business goes bust and everybody loses their money. If you've had institutional investment and things go wrong, it depends what's gone wrong and why, and how diligent and hard-working management are trying to put it right. It may not be anything to do with management or the plan or the original strategy at all. In fact, I'm thinking back across 200 clients we've had in Rafina in the last 10 years, and where things have gone very badly wrong, it was nothing to do with things that were identified as risks in the plan. It was external events, the pandemic or Brexit or some other calamitous thing they had no control over, killed the business. But ultimately, if management has failed to deliver the numbers, which is more common, not overnight, it's sort of incremental thing, then management needs to find a remedy, alter the business model, hire new talent, enter new markets, restructure things, cut costs. And if they don't do these or don't do them well, then an institutional investor usually has the rights to do it for you, which means usually management exiting left.
Yeah, I think that's that loss of control. Even though you may still be a majority shareholder, once you take someone's money, you lose that control, because the reality is when things get tough, you'll need more money, and therefore you are very much at their behest. I think it's an interesting time. We saw an awful lot of challenges. So because I've got a fairly sort of large portfolio of tech and creative businesses, some of them really struggled during COVID and some of them did well. But the ones that wanted more money were the ones that took action early in COVID. And what an investor wants to see is, are the management team up to sorting the challenges out of the business? Because if they just take an approach, well, if we keep doing the same thing, it'll come right in the end, the chances are you won't get that money and therefore you will lose control. But it's about, but the other thing that I also would sort of mention is sometimes entrepreneurs think because an investor's put £500,000 into their business, they'll consider that when they're looking at whether they invest on. Now, in the purest form, most investors will take a stop and say, if we were doing this business as of today, would we invest? And therefore, they shouldn't. Certainly, I think there's a slight difference between angels and institutional investors. But institutional investors will look at each funding point as a separate issue and say, given where we are now, do we fund on? I know it's very hard to forget the fact that you've got $250,000 or $500,000 in the business, but in reality, that's what they'll do. And I had one last summer where the investor had put £1 million in. The investee company only wanted another 150 to get through some temporary funding, but the investor said no, and the business failed because of the actual investment hypothesis, as we call it, which was the fundamental of whether this business is investable or not, wasn't there anymore. So slightly different with angel investors, and angel investors is a completely different topic. But if with an angel investor, it's their money, and sometimes angel investors take a slightly harsher view when it's their money, whereas an institutional investor won't not look after their money any less, but they know that failures happen and will probably be more straightforward in their dealing with you.
Yes, I think
So
that's true.
we're really coming to the end of time, and I don't know if there's any more
Well,
questions, but I have one more question that was put in from people who registered. It's slightly off topic, but it leads very nicely into something else that you're doing, Robin. One of the clients have said, our directors are near to or over retirement age. When should they let the staff know that they are considering selling the company?
Oh, good question. Well, once again, I'm going to give my standard answer, which is it depends. But I can see three scenarios straight off. It slightly depends on the scale of the business and how many people in it and so on. But let's assume it's a reasonable sized business, 50 people in it, who are going to be impacted by management going. So if you sell the business, the tempo is likely to change. Is it just going to be replacement owners, or you're going to end up part of an enormous group, which is a very different culture, very different. And so it's a bit of a shock for employees. So personally, I think you wouldn't tell them necessarily straight away until your path is clear about what you want to do and why. I appreciate they want to find an exit, but your employees will tend to find that very disconcerting, the uncertainty. When you run a business, you become very adept at uncertainty. It's almost opportunity uncertainty. But when you work for somebody else and that's what you do and you don't want the uncertainty, scaring the horses just seems a little unwise until you know when you've got to scare them and why, would be my first reaction. I think the second point I'd make is that do you necessarily need to sell the business? We've got 2 clients who are in their 60s, who've got great businesses. We're raising growth capital for them, but we're also doing a secondary, which means a secondary buyer is coming in to buy some of their significant stake in the business. Now, this means they can take quite a bit of money off the table themselves to sort themselves out and their family and so on, with a view to that buyer buying the rest of the business in 2 or 3 years' time when the new equity has helped it grow and they brought on other members of the management team. The idea being the business stays independent, essentially, which is an alternative, perhaps, to just selling the business. And I think the third thing I would say is that if there's anybody amongst the employees who they think might be interested in running or acquiring the business, and you structure a deal over a number of years to help somebody in that wider employee pool take over the business. Because if they've worked there a long time, they might have real appetite to do that.
And also I see other people who do employee trusts, so they sell the business to the business and then get paid out over a period of time as they work their way out of the business as well.
Yeah. Another way
I'm
of
going to
doing
have to leave it there because we are out of time, and I know I've got more questions, and I know there's more advice that you could give. So if anybody wants to come forward or speak or have some time, then let me know, and I can put you in contact with either Robin or Malcolm or both. But for now, thank you, Robin. Thank you, Malcolm. Robin, you've got a mergers and acquisition webinar later on in the month, which we will also share with everybody, which could be of interest to follow on from here as well. But yes, thank you everybody for attending, and thank you for giving your time.